Welcome back. This will be a quick discussion on private debt. Let's jump right in. Private capital refers to investments in private entities through equity or debt. In the last lesson, we learned all about private equity, so we'll shift our attention to private debt. We can organize the primary methods of private debt investing into 4 categories: direct lending, mezzanine debt, venture debt, and distressed debt. Under direct lending, loans are made directly to a private entity, which is obliged to make interest payments and principal repayment based on a fixed schedule, much like bonds. Similarly, the loan itself typically is senior and secured with collaterals, and has covenants in place to protect the lender. However, unlike bonds, such debt cannot be traded publicly in the market. Much like private equity, direct lending primarily involves private debt firms which raise funds from investors that are looking for higher-yielding debt. The private debt conduct due diligence on the private entities before making the investment on behalf of the investors. Many private debt firms also provide debt in the form of a leveraged loan, which is a loan that is itself levered. That is, part of the capital used for the debt investment is borrowed. This allows the firm to enhance the return on its loan portfolio. Mezzanine debt is subordinated debt financing to private entities that has a lower priority of claims than the borrower's existing debt. Because of its junior rankings and the fact that it is typically unsecured, such loans usually have special features such as conversion to shares rights or warrants as compensation for the additional risk involved. Venture debt is lending to venture firms, referring to startups or early-stage firms that are not yet profitable. Such firms usually lack substantial assets that can be pledged as collateral, so like mezzanine debt, venture debt is often convertible to common stock or combined with warrants to compensate for the higher risks. For example, the lender may be granted the right to buy the firm's common stock under certain circumstances. And lastly, distressed debt. This typically involves purchasing the debt of troubled companies like those that are potentially or currently in default or in bankruptcy proceedings. Distressed debt investors, sometimes referred to as vulture investors, often take an active role in the management and reorganization of the company in order to help turn around the company. The return on investment is a function of the ability of the investor to restructure the company back to profitability. And these are the 4 major categories of private debt investments. As noted earlier, firms that invest in private debt are known as private debt firms, while firms that invest in private equity are known as private equity firms. They are, however, not exclusive. Private capital firms invest in both the debt and equity of their portfolio companies. As with most other alternative investments, private debt provide diversification benefits to an investor's overall portfolio. Private debt investments vary in risk and return, with senior private debt providing a steadier yield and moderate risk, while distressed debt carry the highest risk but potentially the highest return if the turnaround is successful. As a whole, investing in private debt is riskier than investing in traditional bonds. Investors should be aware of these risks, which include illiquidity and heightened default risk when loans are extended to riskier entities. Such risks are often compensated by higher yields than public traded bonds. And that's our quick discussion on private debt. Next, we move on to commodity investments. See you again.